Thank you, Simon. Welcome, everybody. My name is Tebogo Leshilo. I am the Executive Head of Complex Risks within the Financial Lines Business Unit here at SHA. Thank you very much for joining us. Today's presentation will provide an overview of the challenges facing directors and officers in executing their fiduciary duties in the face of COVID-19. We'll also look at the types of claims that directors may expect to see at this time, together with D&O underwriting considerations taken by insurers. COVID-19 presents as a black swan event. We find ourselves in unprecedented times. I don't think that any of us 6 months ago could have imagined where we are today. It's day 120 since South Africa entered the national lockdown, and the impact of COVID-19 has permeated across multiple sectors of our economy. Open any newspaper, scroll through your social media, things present a fairly grim picture at the moment. We see businesses that are unable to trade on account of government-imposed restrictions, as well as reduced demand for their services and products. We're seeing an increase in the number of retrenchments, as well as unemployment figures across multiple sectors. Many companies also find themselves under pressure to manage their customers, as well as the employees' exposure to this virus. On the one end, we've also seen industries that have found themselves in a position where they've been able to pivot their service offering or their manner of delivery. Car manufacturers have pursued the production of ventilators, as well as masks and filters. We've seen the proliferation of online channels or no contact delivery channels for basic home goods and services, such as the Woolworths Click and Collect offering that they've recently introduced. Unfortunately, we are also facing the challenge in the healthcare sector, where our hospitals and medical personnel are facing difficulty in deploying adequate care to COVID-19 infected patients, as well as other parties. Whilst we can't say that there's industries that haven't been touched by COVID, there are certainly specific industries that we can highlight as having been somewhat overexposed by the restrictions, as well as the inability to trade at full capacity. The speed at which many countries locked down their borders, closed international as well as local travel routes, has seen the aviation industry literally ground to a halt. Many countries are only offering repatriation flights, whereas the airspaces remain closed unless it's for cargo and goods and services. Locally as well as abroad, we've seen airlines enter the business rescue, where they've either sought additional funding from government or alternative investors in order to maintain operations post the pandemic. Locally, Comair has entered voluntary business rescue. This is as a means to safeguard the interests of their employees, the company itself, as well as their stakeholders, while they seek to find a different way to operate sustainably as an airline once we have gotten past the worst of the COVID pandemic and we're able to operate airlines again. The tourism and hospitality sector, we can say we've seen what we can call a knock-on effect perhaps, where South Africa is not seeing, for obvious reasons, any international travelers. Unfortunately, a lot of these companies are now faced with very high vacancy rates, together with having to maintain fixed running costs that will not change in light of the lack of any customers. We've seen in the past month or so where the Marriott Group terminated their agreement with Grace, the Mount Grace Hotel, and Toho Sun, a local hotel group, has come in to provide additional funding and support, enabling them to continue operations. While lockdown level 3 has seen a relaxation in government regulations regarding the ability of restaurants to trade, reduced demand for their services, as well as the lack of alcohol being served within these establishments, has proved punishing on their financial position and their ability to survive going forward. We do anticipate an increased wave in the number of restaurants that will not survive the COVID pandemic. Looking further afield to industries such as manufacturing as well as shipping, breakdowns in supply chains where you may be reliant on high levels of imports or exports for either full-on trade or certain components that are added into the manufacture of products will also have a very negative impact on revenue. So overall, South Africa finds themselves in a very challenging financial position. This can't be attributed to COVID-19 alone. Prior to this, we have found ourselves with very high debt levels, down ratings by global credit rating agencies. The impact of the COVID pandemic will be far-reaching. I don't expect a recovery anytime soon with regards to the economic position of our country on both the macroeconomic and microeconomic level. We'll now look to the duties of directors and officers. Directors and officers have always been held to a high standard of care. This is as stated by the fiduciary duties imposed on them by the Companies Act, as well as the standards set within the King Codes. As we sit now within the COVID pandemic, I do feel that they face additional challenges in exercising reasonable care, skill, and diligence as they go about executing their fiduciary duties. Failure to fulfill these duties could potentially result in them being held liable in their personal capacity for damages suffered by the organization or any other stakeholders. This is where directors and officers insurance comes in as an integral part of the company's risk management strategy, especially in this environment where we have an increased spotlight on corporate governance. The cover offers liability for directors and officers, protecting them from personal liability for wrongful acts, which are alleged or actual, relating to the decisions and actions taken as they manage organizations. The way that companies navigate this COVID-19 pandemic could easily see the door open for mismanagement claims, as well as alleged breaches of duty or care, as well as poor oversight. As directors operate within this strained environment that we find ourselves in, they do at all times need to remain conscious of their responsibilities as well as their duties appointed upon them as a result of their position held. Managing any company, irrespective of the service provided or the sector of the industry sector, is challenging. This is further exacerbated by the COVID-19 pandemic. There are multiple facets that need to be taken into consideration. The importance of human capital, such as the employees of any organization, cannot be ignored at this time. The protection and health and safety concerns for all laborers needs to be taken into account, be they working from home or within the office or site or factory where they function. Furthermore, we cannot necessarily avoid any retrenchment activity that may be necessary. However, compliance with local legislation regarding labor relations needs to be taken into account at every stage. The prudent management of finances, be it the issuing of capital, adherence to debt covenants, and managing cash flow on a day-to-day basis cannot be undermined either. These are the specific areas that will definitely come under the scrutiny of multiple stakeholders, such as investors and regulators once companies reach points where they're in states of severe financial distress. We also need to remember that directors face the challenge of making appropriate disclosures regarding the development of the coronavirus pandemic. This ties in with regulatory conditions that previously existed, if they are accountable to any external regulators, as well as measures of compliance and governance internally within the business. Companies cannot be discharged of their obligations as far as governance and principle in practice is concerned. Where directors and officers at this point in time need to draw from their existing resources is especially in leveraging the years of experience that they have. It's important for them to apply measured foresight as to strategy and planning going forward as we look to operating in a post-COVID world. A failure by directors to adequately respond to these changes in the environment could easily see them facing claims for alleged or actual wrongful acts. We'll now look at potential sources of D&O claims. These are driven by the multiple challenges that directors and officers may face in effectively executing their duties in this challenging operating environment. Whilst the number of claims does remain fairly modest in our local environment, evidence from global markets indicates that we will see an increase in the months ahead as businesses are faced with the impact of the coronavirus on their operations and finances. Several sources of claims could be related to the manner in which the company acted as the pandemic unfolded. Were there adequate contingency planning measures in place? Were these effective in protecting both the interests of investors as well as the interests of their staff? Employment practices, as I previously mentioned, can definitely not be disregarded in the management of any labor-related issues. As many companies have moved to a work-from-home environment for large portions of their staff complement, we've seen the existence of many cybersecurity shortcomings in IT systems and processes. Privacy failures, as well as the failure to purchase insurance, could find directors and officers under scrutiny or held liable in the event that company records are exposed unnecessarily. It's also important for directors and officers to make sure that the disclosures that are made to investors regarding the financial impact of the pandemic, as well as any statements relating to activities as well as forthcoming strategic decisions, are communicated to all stakeholders in an accurate way without any misleading or inaccuracies. The failure to purchase insurance is, I think, particularly relevant when we look at cyber exposures. In the event that it's found that directors did not adequately seek to ensure that these covers were in place, we could see an incident of D&O claims that arise. So at the moment, while we have not seen anything, we most definitely do need to be on guard for the types of claims that may arise, as well as effectively manage and protect the interests of the company with regards to any decision making that's made at this time. We cannot deny the challenges faced by directors and officers. I certainly do not believe that they are insurmountable. There are mechanisms and measures in place that can be implemented, as well as that can be implemented in order to ensure the protection of both the company as well as the interests of directors and officers. Directors and officers need to be proactive in the steps taken to monitor and conduct oversight of a company's operation. This is not the time to delegate tasks as well as decision-making to other members of management, but this calls for a collaborative approach to be taken between directors and officers, key management, through assessing the overall impact on a business. One of the best ways in which this can be done is through the appointment of COVID-19 committees. The roles of these designated committees would include reviewing the crisis response plans that companies have in place, identifying any crucial deficiencies or gaps within the operations of these response plans, and also effectively ensuring that reporting and monitoring is done on an ongoing basis. What we're seeing as this pandemic rolls out is that nothing remains static. The constant evaluation and understanding of exposures, as well as the adequate level of response in dealing with exposures, cannot be taken lightly. Records management and documentation of all procedures implemented in response to the virus needs to be taken into part. Whilst directors cannot hold in-person meetings, they most definitely do need to continue holding virtual board meetings with COVID-19 related matters designated as a single line item. All directors and officers' board meetings need to be documented for future purposes. While we've shared with you an overview of the COVID-19 pandemic and the economic impact thereof, as well as how the duties of directors and officers tie into the manner in which they operate and manage companies at this time, I do think that it would be prudent to share with you some of the considerations that are taken by underwriters as we approach D&O renewal accounts. Having just come out of the 1 July renewal season, we are no doubt all exhausted. I do think it certainly gets worse with each year. However, 2020, with my years of experience, will most certainly go down in the books as my hardest renewal season. Underwriters have several levers at hand that we can use as mechanisms to approach any type of risk, be it D&O or any other types of covers. What we most certainly have seen at this time are 5 critical levers which we've implemented in response to the current D&O market. Most importantly is the nature of pre-risk inquiries that insurers have undertaken relating to COVID-19 exposures. D&O has typically been underwritten in a manner which we can say was very backward-looking, where whilst we've had the support of current news in the public domain relating to performance of companies, information relating to financial performance and their financial position has typically been at least 6 months to 12 months old, in some instances even older. The approach that underwriters have taken at this stage is to look at asking forward-looking questions that really interrogate a company's readiness and response in respect of COVID-19. The key questions that we want to know relate to the state of a company's liquidity, their ability to service their debt covenants, how they're looking from the perspective of business continuity measures, any resilience plans that have been put in place, as well as forecasting on both the strategic and financial level. It's crucial that us as underwriters understand and are comfortable that these companies are able to withstand the economic downturn that will follow this pandemic as it rolls out. Risk selection has presented as a key factor in underwriters' decisions to bind new business, as well as our treatment of renewal accounts. Whilst we can't sweep industries with a broad brush, we do need to be aware of the COVID-exposed industries, as well as what their likelihood of sustainability going forward may be. The impacts differ even within same industries. If we look at retail as a sector, while the high-end retailers may be negatively impacted by coronavirus as their clients are under financial pressure and forced to revise their spending, this could provide an opportunity for lower-end retailers to improve their revenue basis. Traditional movie theaters were already under pressure prior to COVID-19, given the advent of online and on-demand services such as Showmax and Netflix. We can certainly expect an increased deterioration in their performance, while on the other hand, at this moment, online and on-demand services will definitely see increased share prices and performance. If we look at the healthcare sector, again, the approach taken by directors and officers may differ. Companies that provide medical equipment or PPE may see an uptake in the demand for their services. We may consider these favorable accounts to review, whereas we may apply a more stringent and measured approach to other healthcare-related companies seeking to develop coronavirus-related vaccines. Overall, I do think that a much more stringent approach has been taken regarding the decision as to whether we underwriters will write a risk or not. Additional lever that often accompanies underwriters' approach to risk selection is that of limit management. We're seeing the industry respond with reduced capacity, typically across the board, irrespective of the sectors involved. Underwriters are seeking to manage their exposure as well as their risk appetite. We've also seen a move away from primary layers. There seems to be at the moment a higher interest as well in attaching at higher levels on excess programs. What has also been impacted by the reduction of capacity across the market is the number of players that have been introduced on many existing insurance programs. From the perspective of terms and conditions, we are, as underwriters, offering more restricted cover. We are seeing the implementation of exclusions on cover, such as insolvency exclusions, in the event that we are not comfortable with the financial position, be it at present or in the future, with regards to particular risks. What is a fairly contentious issue is the application of a COVID-19 exclusion on D&O policies. The treatment of this has not been applied in the same manner across various insurers. While some insurers have opted to take the approach of underwriting far more rigorously in respect of the COVID-related exposures, others have taken the approach to apply this on a blanket basis right across the D&O portfolio. It must be said, though, that there does seem to be a higher incidence of COVID-related or infectious disease-related exclusions on PI covers rather than D&O. I think finally, the one factor that obviously hits clients hardest in their pockets relates to premium, as well as the rate online that we're implementing on D&O policies. 2020, I would say, presents as the second round of premium increases that have been seen across the D&O market, as we've moved away from the soft market where risks used to be priced at 1,000 per mil. We're now seeing multiple premium increases across the board on both primary and excess layers. The same has been applied in respect of both public and private corporations as well. In closing, we most certainly can agree that the road ahead remains challenging for all players, be it companies, directors and officers, as well as insurance companies. The increased level of companies in financial distress, those entering insolvencies, will see a lot of pressure on our economy. This will also show in the rates charged within the D&O market. I do expect that we will see an extension of this hardening market somewhat, as the cost of reinsurance capacity increases for many carriers. together with the increased claims notification, driving up the cost of legal defense costs for insurance companies. Whilst this presents a challenging environment, I most definitely do not believe that it is only a picture of doom and gloom. I think that opportunities for collaboration exist between insurers as well as brokers when we look at the product that we are delivering to our clients. This is not necessarily the time to abandon clients going forward. We need to participate in our economy, protect the interests of directors and officers as they do what they can to navigate key resources for South Africa going forward in this pandemic. I'd like to say thank you very much for everyone taking the time to join us today. I hope you enjoyed the session. Should there be any questions, you're welcome to type them in the comments box and we'll address them at the end of the session. Thank you. Back to you, Simon.